Hello and welcome to episode 334 of the Money to the Masses podcast, but without your resident expert, as always, Damien Fay and me, Andy Leeks. Well, as we mentioned in the podcast last week, Damien is taking a well-earned break and has let the team kind of do this for themselves. So it may only happen once if it's not quite up to standard, but we're hoping that we do Damien proud. So this is the team takeover, episode 334, and we've got Bronte, we've got Harvey, and we've also got Laura coming up on the show doing various bits and pieces. So we're going to start the pod this week by speaking to Bronte, who's going to be coming on the show and talking about house prices. More on that in just a second. We've got Harvey coming up in the middle of the show, who's going to be talking about a particular life insurance product that is often misunderstood, whole of life insurance. So stick around for that. And then at the end of the show, we're going to be speaking to Laura, who's going to be talking about credit ratings, what can impact them, and whether taking out a loan to try and improve your credit rating is a good idea. So let's start with Bronte then. Bronte's sitting right here with me. Bronte, how are you doing? Welcome to the show.
Thanks. Hi, I'm good. How are you?
I'm great. I'm really looking forward to this. This is the first time we've ever done a team takeover, and it's really nice to be able to get in lots of different voices on the podcast this week. And actually, the piece that you're going to be covering, I'm quite excited about because I'm looking at house prices at the moment. I'm looking to remortgage and I'm interested in what impacts house prices. And so, Bronte, you're going to be covering off the top 15 homebuyer turnoffs that could end up costing sellers more than $65,000. So these are the kind of things that we as sellers want to make sure that we get sorted before we put our property on the market. So we're going to cover these off like a list. And so let's start with the first one.
Okay, so before we dive in, just to let you know, we've calculated all of these costs based on this month's Rightmove estimation of the average UK property price, which at the moment is £337,371. So the first and most costly issue is subsidence. Now, subsidence is what happens when the ground beneath the property is sinking or collapsing into the ground below it, which obviously massively compromises the structural integrity of the building and can be extremely expensive to repair. That's why it's estimated to wipe as much as 20% off the value of a property. Now, based on our calculations, that amounts to £67,474. So the second most costly issue is a Japanese knotweed infestation. So you may have heard of Japanese knotweed before. It's basically a really rapidly growing weed. It can grow as much as 10 centimeters in a single day, and it's known for being able to take over an entire property and potentially damage the strength of walls, foundations, and other sort of integral structures. And a Japanese knotweed infestation can actually knock as much as 15% off the price of your property. So again, that could leave you down as much as £50,605. So moving on to the third one, which is poor upkeep. So this sounds a little bit vague, but it's arguably the most obvious turn-off for a prospective buyer. So this could be anything from an overgrown garden or a kitchen that desperately needs refitting. But all these issues can paint basically a less than desirable first impression, and it can actually drag a property's value down by 14%. Or £47,231, which is a shame considering most of these issues are quite easily fixed.
Exactly. So these are the sort of things that you see people desperately trying to sort of scrabble around and pick out the weeds, cut the grass, put the magnolia paint on the walls, make sure all those little dinks and dents that the children did when they were moving their toys around, they're all sorted so that to the naked eye, when you look, things look all right. You're kind of covering the cracks almost. So people can do that quite easily, can't they? So what's the next one then?
So the next one is a little bit difficult for someone who's selling their house to control, but it's actually unattractive surroundings. So this could be anything from an electricity tower that's quite near your house, or like excessive overhead power lines that you can see from the windows. And although there's very little you can actually do about that, it's important to keep in mind because it can actually cost you 13% of your house's value, which is about £43,858.
So actually that's a good point on people who are buying properties and maybe looking at the price and trying to hunt for the reason that it might be cheaper than they first would have anticipated for the area or for the upkeep of the house. It may just be because there's a pylon in the back garden or something, just something to keep in mind, because that's going to be passed on if they end up buying that house. When they end up selling it, that could be something that could be effectively passed on, that reduction. Okay, what's next?
Okay, so number 5 is something we're all familiar with, and it's nuisance neighbours. So it doesn't matter if it's because they're noisy or they're messy or they're just kind of really difficult to live next to. nuisance neighbours can actually wipe up to 10% off the value of your property, which comes in at about £33,737. So again, a very costly issue.
So maybe people who have got nuisance neighbours, they might want to invest in, I don't know, paying for a little holiday for them to go away for a week or two while the house is being viewed. So what do we got next?
So number 6 is flood risk, and this is an increasingly relevant issue with climate change, as I'm sure everyone's aware of, but a property on flood risk territory could also sell for about 10% less than you might expect. And then there's lack of convenient parking. So if you already live in a flat or on a busy street, you'll probably be familiar with this kind of struggle, but it can actually knock 7.1% off a property's value, which is about £23,953.
Do you know what, though? That's money well spent. And obviously, convenient parking is going to reduce that property value potentially. But on the flip side, sometimes I look at houses and think, why are they so expensive? Then I realise there's off-street parking or a driveway or a garage. And then I kind of get it. I've lived in terrace properties with on-street parking and with double lines and parking restrictions. It's just a constant nightmare. So I can see why that does impact the cost of properties. What do we got next?
So number 8 is door numbers. This one's quite interesting. So whether or not you're superstitious or not, a lot of prospective home buyers, either consciously or unconsciously, can be put off by an unlucky door number, such as the number 13 or 666. So a property with an ill-omened address can actually sell for 6% less than you might otherwise think. And that's a difference of about £20,242.
I was glad to say I've never lived at a number 13 or a number 666 and don't intend to, but now I know that it could impact the cost. What have we got next?
So number 9 are structural issues. So this can be anything from a crack in a load-bearing wall, or if you've got a leak in your loft, but this can take as much as 5.3% off a property's value. So that comes in at about £17,880. And generally, these are the kind of things that you'll want to address before you put your house on the market anyway. And number 10 are any local power stations. So again, this is something you probably, if you're selling your house, you don't have a whole lot of control over, but sort of the hum and the visual clutter that can come with having a power station near your property is also a really major turnoff for prospective buyers. And this can cut nearly 5% off your house's value. So that's £16,531. So quite costly.
Okay, so we've covered off 10 there in relative detail. And we said at the start of the podcast, and the article itself covers 15 of the top home buyer turnoffs. So I tell you what, why don't we cover off the last 5 in a quickfire style? What have we got for the last 5 reasons?
Okay, so number 11 is pet damage or pet odours, and this can cost you 4% of the property's value. So that's coming up at nearly £13,500. Then we have cluttered rooms. This one's a really easy fix, but in terms of when you're showing people around your property or the photos you've got for your listing, this can also cost you 4% of the property's value. Now, damp and mold are also really serious issues, and even though they tend to only cost about 0.9% of the property's value, that still comes at over £3,000, and it's a relatively easy fix. Now we've got asbestos. So most of you are probably aware that this is an issue that's quite specific to older properties, but asbestos, being a notorious carcinogen, is a massive turn-off for prospective home buyers, so it could cut the price of your property down by just under 1%, so again about £3,000. So even though removing asbestos can actually be quite expensive, this is going to make it way more attractive to a potential home buyer. Now finally, we have a woodworm infestation. So not only is this a huge buyer turn-off anyway, but it can also be a genuine risk to the structural integrity of your property, and it knocks about 0.5% off your average house's value. So even though that's only about £1,500, it pays to not have to worry about any creepy crawlies hiding in the cracks and crevices of your property.
Okay, so there we have it. There's 15 of the things that could seriously impact the cost when it comes to selling your home. And Bronte, I know in your article you covered a few of the ways that you can boost your property's desirability when it comes to selling. So do you want to give a few of those tips? And obviously we cover those in the article themselves. What tips would you give?
Well, first of all, you want to be focusing on addressing any of the issues we've just talked about, such as repairing damp or, deep cleaning to get rid of any lingering pet stains and odours, because altogether these things could cost you as much as 20% of your property's actual value. So pay special attention to sorting those things out first. So on the website, we've also got articles about the 6 mistakes people make when trying to sell their property, 10 tips on how to showcase your property to make it most desirable to prospective home buyers, and 5 reasons your house may not be selling and what you can do about it. So do be sure to check those out for any more home buying and home selling information.
Okay, Bronte, that's it. We're done. Thanks ever so much for coming on the podcast again and being part of this team takeover pod. And as I like to say to Damien, and because I can't say it to him this week, I'm going to say it to you. So until next time.
Thanks so much for having me, and until next time.
And so for the next section of the Team Takeover podcast, we're going to welcome Harvey back to the show. Harvey, if you're a regular listener to the podcast, has been on the show a few times, and she's our resident expert that talks about all types of personal insurance. Now, Harvey, we brought you onto the show this week because there's been quite a lot in the press about a particular product, and it's been quite negative in terms of the general view on this product. And I wanted to bring you onto the podcast to really dispel some of those myths and provide a bit of balance, because with every type of product, whether it be insurance, loans, credit cards, there's always going to be some people that it's good for and some people that it's not so good for. So, Harvey, welcome to the show. What are we talking about this week? And provide a little bit of context as to what the next part of the show is about.
Hi, Andy. Thanks for having me back, and it's great having a little bit of fun while Damien is away. So this week we're going to talk about whole of life insurance policies. There has been a little bit of negative press around. The unfortunate thing with most types of insurance products is that the news really picks up on stories where the products fail rather than when they work. So yeah, we'll dispel some of the myths and hopefully give a bit of useful information for our listeners so that they can work out what is best for them.
Great. So, I mean, let's start with the basics. Whole of life insurance. It's a bit of a weird name for a product. You'd think life insurance covers people's lives. What does whole of life insurance mean? What is the product?
I mean, often people who buy life insurance assume that life insurance will pay out when you die. The truth is that most of the products that are available in the market and the ones that are most commonly bought are term assurance products. The term assurance products only pay out if you die within the term. So you buy the policy for a number of years, and if death happens within those years, then the policy pays out. And if you live beyond the term, then great, you've had the cover whilst you needed it and the policy doesn't pay out anything at the end. Whole of life insurance contracts are slightly different. So they actually do what people assume a life insurance policy would do, which is they pay out when you die, as and when that happens. So whether you die early in life or you have a full and long life and die well into your 80s and 90s, it pays out when you die. So whole of life contract is that. It's a life insurance policy that pays out when you die.
Okay, so that's great. We understand now that there's kind of two different styles of life insurance. The main type of life insurance that people will end up buying is what they call a term life insurance product, which has a limited number of years that you select, and it's usually to cover things like mortgages, loans. Maybe if you've got a young family and they're dependent on you, you need to be able to have funds available to replace someone's income. So then there's this other one that you've just explained, whole of life insurance. Who needs that, and why would people buy that product as opposed to the term cover?
Whole of life insurance, Andy, is a slightly different beast when it comes to life insurance because people are driven by a different desire. So to want a payout or a sum of money to pay out when you die, regardless of when that happens, means that there's going to be a cost upon your death. So the kind of things that people leave money behind to pay for are things like funerals. They might want to leave a gift for somebody. They also may want to fund the inheritance tax that will be payable on their estate once they've passed away. So those three things are the main reasons why a whole of life contract is usually bought. You do get some policies that are called over 50s plans, which are a little bit like funeral plans, but essentially they're like a whole of life contract. They're a policy that's going to pay out when you die.
And so, as we mentioned at the start of this piece, there has been a bit of negativity surrounding this product. Why is that?
The negativity is stemming from a particular type of whole of life contract. So whole of life contracts in previous years have been available on a maximum or a balanced basis. Now, a maximum whole of life insurance policy is one where you would have started out paying quite a low premium for it, but what it does is it reviews on a regular basis. It might be every 5 years, it might be every 10 years, and the insurance company will assess whether the money that you've paid for your policy is actually going to be enough once it's invested and grown to fund the payout that needs to happen when you die. Now, if that premium that you've paid is not enough, the insurance company will give you a choice. They'll say, we can increase the amount that you're going to pay for your policy so that we still pay out what is required when you die. Or they'll say, you can keep your premiums the same, but we'll reduce what is going to be paid out at the end. And it's that kind of policy that has warranted a lot of this negative press that's come out. The reason why these types of policies have attracted a bit of negative news coverage recently is because there are a few people who haven't really understood how the policy works. That might be because the advisor that sold it to them hasn't explained it properly. They perhaps haven't understood the jargon that's been within the documentation that they've received from the insurance provider. But essentially, at each review, the insurance company is working out whether the premiums that you're paying once invested will grow to fund the level of payout that needs to be made when you die. Now, if growth slows down, as it sometimes does, and, if the markets don't produce the kind of returns that the insurance company was expecting from the money that you were paying, then generally that review is going to result in an increased premium or a reduced sum assured, the sum assured being the amount that will pay out when you die. And that can be quite disappointing for policyholders if they haven't understood that properly at the outset.
Okay, that's great. That gives a bit of context as to what sort of whole of life is, why you would use it, and on that maximum type of whole of life, why people have come unstuck. I get it. So you mentioned earlier that there's different types of whole of life insurance. They've got different names, haven't they? I think you mentioned balanced was another one, and guaranteed. Should we explain the other two types of whole of life insurance and what they will mean for people who are either got them or are thinking of buying them?
Absolutely. Now, we'll explain the balanced one first, and then we'll talk a little bit about the guaranteed types of policies, which are predominantly the ones that are available in the market today. But if you've got a policy that you took out some years ago, then you might have something called a balanced whole of life insurance policy. Now, the balanced ones were probably a little bit more expensive at the outset, but the reason why they're more expensive at the outset is to stop massive hikes at the reviews. So what the insurance company has done is they've factored in a little bit more in terms of what the real cost of the policy is going to be from the outset. So you're paying a little bit more when you start the policy, but you shouldn't see the kind of hikes as time goes on as you would do with a maximum whole of life insurance policy, where the policy would have been quite cheap at the outset. And then if you compare that again with the third type of whole of life insurance policy, which is the guaranteed one is the safest bet. So like the name suggests, the premium that you pay for a guaranteed whole of life insurance policy is fixed for the duration. So for as long as you live, you will pay the same premium throughout. And predominantly that's the type of policy that's available in the market now.
Great. And so just to finish off this piece, really, we've explained what whole of life is, the different types, how it's different to term life insurance. Who are the people that this product is really going to benefit? We've talked earlier about families, and people with mortgages are generally going to get more use out of a term life insurance product because it's good value and it serves the need, and it will pay out a large sum assured if you were to die at that point in life. It will cover the mortgage. It will help your family. Whole of life insurance is a different policy. Who is that benefiting?
It's benefiting those people who have some sort of cost that's going to arise when they die, regardless of when that happens. Now, when we talk about mortgages, we talk about loans, we talk about children who are dependent on us, these things are usually only true and a concern to us whilst we're working, because it's that income that we generate during our working lives that funds our mortgage, that funds raising children, and other aspects of our lives. So our lives see an actual financial impact if we die during our working lives. So most people that require life insurance for those reasons need only take that policy for as long as they think they're going to need it. And that might be until the end of your mortgage. It might be until your children are of an independent age, or you might just opt for something that covers you until you're going to naturally retire. And that's sufficient, because if you get to that point in your life and, hopefully you've paid off the mortgage, children have grown up and they've gone off on their merry way and you've done a good job, and at that point, you're not really worried about the impact of your death on others in your life. So at that point, most people start thinking about the inheritance tax that might be applicable to their estates. So if your estate is in excess of 325,000, there are other factors that you need to consider when working out your inheritance tax, but we'll tag in some content that's on our website that helps you work out what the inheritance tax bill will be on your estate. If that is you and you need to be concerned with funding some inheritance tax, either your beneficiaries can pay for that, or you may want to put in place some life insurance that you put in a trust and leave to your beneficiaries so that they can pay the tax that's going to be applied to the estate when they receive it.
Okay, to finish off this piece then, there are going to be people who knowingly or unknowingly have a whole of life insurance policy that is possibly on this maximum or balanced basis. They're looking at it, potentially they're looking at the cost of it, and they're knowing that there may be increases that are coming and perhaps they can't afford those increases. What can they do? Is there anything they can do about this?
The first thing to do, I'd say, Andy, is speak to the insurance company. If your advisor who provided the advice when you arranged your policy is still in touch with you, perhaps contact them as well and discuss what options are available to you. The insurance company generally give you options to reduce the sum assured, but you might feel that that's not viable or it doesn't feel like it's cost effective for you. Some policies can be made paid up, so they're paid up to the point that you've made your premiums and you're no longer going to pay into them. That option doesn't always exist. And some policies will have a surrender value. So for a lot of people, they may ask for the surrender value, and the surrender value may be not attractive because of the amount of money that they've already paid in, and that becomes problematic. But I think that open up a discussion with your insurance company, speak to your advisor if you're still in touch with your advisor who sold the policy, and discuss what can be done. I think the key thing here is, Andy, as much as it can be painful to know that you've spent a lot of money on a product and it's now not going to do what you expected it to do, is not to throw good money after bad, and not keep paying for something in hopes that it will get better at some point. So have those conversations, but the answer is going to be different for different people dependent on what they set up the policy to do and how far into the process they are and what the figures look like for them.
Great. So as you mentioned, Harvey, we're going to put some links to some articles that will help people just understand a bit more about whole of life insurance. You've written those articles, Harvey, and people can take a look at those on the website, and we'll also link that to the show notes in the podcast. Thanks ever so much for coming on, Harvey.
Very welcome, Andy. It's been a pleasure as always.
And so for the final piece on the pod, we're going to be welcoming Laura back to the show, who's going to be talking about, can getting a loan improve your credit rating? Is it a good idea? Maybe the pros and cons, and well, basically whether or not it's a good idea. So Laura, welcome to the show.
Yeah, so this is something that is often talked about in the various money groups, including on our own Facebook group, where people kind of consider whether, if they've got a poor credit rating, getting a loan or perhaps a credit builder credit card could help them to improve their credit rating. And while it's undeniable that by taking out a loan or another credit agreement and being responsible, keeping up with your repayments and just making sure that you make all of those payments on time will improve your overall credit rating, there are some other things to consider before you go down this route. There are some potential drawbacks. So the first of those is to think really about whether you need to take out this loan. Is there a specific reason for it? It's never a good idea to borrow money that you don't need to borrow or there isn't a specific purpose for borrowing, particularly because by taking out a loan, you're using up some of your sort of credit quota. So when other lenders, for example, a mortgage lender is assessing the affordability of a future product you take out, they're going to be looking at any outstanding loans and the payments that you have to make to those. So you can end up inadvertently limiting the amount that you can go on to borrow for, say, a mortgage or a remortgage, or even something like car finance, may be put slightly at risk by having this existing loan in place. The other thing that you need to consider is that if you have a history of bad credit, if you haven't got the greatest history of making repayments on time, or perhaps if your financial circumstances change and you're unable to keep up with the repayments, the effect that it will have on your credit rating if you've already got a bad credit score will be absolutely huge. So if for whatever reason you default on the loan, it could dramatically affect your life in the future. It may stop you from getting a mortgage. You may not be able to secure car finance. And it can even go so far as limiting the current accounts that you could potentially open in the future. So these things are all worth bearing in mind before taking that step to take out a loan simply to improve your credit rating.
And so that guidance really that you've given there is all of these types of products that are marked as credit building. So that's the loans that you see out there, but there's also the credit building credit cards as well that you mentioned.
Yeah, and also the thing to bear in mind with all of these things, and especially these credit builder credit cards, is you're going to pay a much higher rate to take these products out, which could then impinge your ability to actually make the repayments. And it's just better to look to improve your credit score in other ways. And there are quite easy steps that you can take to make you a more attractive proposition to lenders in the future.
Great. Well, that moves us perfectly on to what you're going to talk about next. So what is it that people can do? Because there'll be lots of people that have either been in this situation or are currently in this situation, or perhaps even know someone and they can maybe give a bit of advice. So maybe they've considered these credit builder loans or credit builder credit cards, dismiss those. What else can they do?
I think a first and quite simple step is just to check your credit file with the main credit reference agencies, so Experian, Equifax and TransUnion. And by doing that, you can make sure that there aren't any mistakes on those files, to correct those, to check that anything like, for example, a CCJ, that the details around that are correct, that if it's been satisfied, that the date that it's been satisfied is correct. And also just making sure that everything is accurate in terms of your address, your date of birth, and any other information like that. Also, a really simple step is to make sure that you are on the electoral roll. That will help to boost your credit score. And then there are also other services that are available that are designed to improve your credit rating. So, for example, we have Lockbox, where you pay a monthly amount into what they will label as a loan, but which is in effect a savings account. So you're demonstrating that you can commit to making monthly payments on time and in full, which will help build your credit rating. But at the end of a set period of time, you then get that money back. So in effect, it's like a savings account rather than a loan. There's also Experian Boost, which can help you, as the name suggests, boost your credit score specifically with Experian. And that looks at things like whether you have Netflix or Amazon Prime, those kind of subscription services. And also it uses open banking to see what your spending habits are, and things like paying your council tax or paying into savings or investments will count in your favour, and you'll immediately be awarded with a higher credit score if you meet certain qualifications. And that service is completely free.
Great. And so, Laura, you've written an article on this, which we'll link to in the show notes. And we'll also link the articles to the full review on Lockbox. And also you've done a review on Experian Boost as well. So you can access all that through the show notes, either on the podcast link or through the article on the website. So that's it. We're done for this week. If you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. We're on Instagram, The Facebook group is facebook.com/groups/money to the masses. That's a real mouthful, that. Laura, I would normally have Damien to say goodbye to here, but you're going to do it for this week. And as I said to Bronte just a second ago, and I want you to say it too, until next time.
Until next time.